G'day guys and welcome to another episode of the Aussie Investing Machine. If you're an investor like me focused on picking growth stocks, have you also considered how you could earn some passive income from the stock market? Is there a way you can rebalance your portfolio to take advantage of the many stocks on the ASX which pay really good dividends? The returns you can get from some of the dividend stocks on the ASX are far higher than the rates you might get from a cash savings account at one of the big four banks. In this episode, I'll share a strategy with you so you can do just that with minimal time and effort. After that, we'll look at the company NextDC. NextDC is a company focused on data centers, and they're a company in direct competition with Megaport, who I did a video on a little while ago. If you'd like to check out that video on Megaport, I'll put a link up on the screen so you can go and check that out. As always, this video is for educational purposes only and does not constitute financial advice. Before making any investment decisions, make sure to go and see a licensed financial advisor. Now, before we get started, make sure you smash that like button. It really helps the growth of the channel. And if you haven't already, make sure to hit the subscribe button and make sure to turn on notifications so you don't miss an episode. Given the latest interest rate cuts in Australia, more and more people are turning to the stock market for decent returns on their cash. Now, I love investing and picking growth stocks. Picking the right stock and watching the capital value go through the roof is not only really satisfying, but it can also be quite lucrative. However, as you would probably know, as fast as stocks can go up, they can certainly fall just as quickly. Those of you out there who hold stocks like Mesoblast and Novonix will certainly be familiar with this. So what can you do to safeguard your portfolio and also enjoy some quarterly dividend distributions at a really attractive rate? If, like me, your main focus is on growth stocks, you'll find that your time to research and analyze good dividend stocks is probably limited. For this reason, it might be a good idea to have a look at an ETF that focuses on high dividend yields. The advantages of going down this pathway are clear. With an ETF, you'll typically get quarterly distributions, really low management fees, and a diversified stock selection within the ETF portfolio. Some funds proving really popular lately are the Vanguard Diversified High Growth Index and also the Vanguard Australian Property Index. These funds have really solid distribution payments. However, there are many other funds that have listed ETFs such as BlackRock iShares and also BetaShares. The secret to getting a quick snapshot of how these funds have been performing over the past 1, 5, and 10 years is to look at the fact sheet, which you can see on the website of all of these funds. On the fact sheet, you'll find information such as how often dividends are paid, whether it's quarterly, biannually, or annually. You'll be able to see the capital growth rate and also the dividend yield for any given fund. These numbers are not always easy to find across the website, so it's important to check the fact sheet because they're usually in a uniform format, which makes it easy to compare between different funds. So what sort of investment do we need to make in order to get a return of something like $100 passive income per month? Well, say we go for a fund which has a dividend yield of around 5%, which in my opinion is conservative. We'd need to start with an amount of approximately $24,000. With that size investment, you're looking at approximately $300 a quarter or $100 a month. That's a decent chunk of money and could certainly make a big impact if it was reinvested or if you just wanted it for extra spending money. It certainly beats spending 24 grand on a new car, which, as you probably know, is a depreciating asset. Now, certainly some of these funds have a dividend reinvestment plan, which can be an excellent way to build wealth. Instead of the dividend being paid to you directly, the fund will use the money to repurchase more shares. If you were to employ a dividend reinvestment strategy on that initial investment of 24 grand, you could expect that amount to double in the next 10 years if you went for one of Vanguard's high yield ETF funds. Just to show you exactly what I mean, I'll put up on screen a calculation of exactly that. For this calculation, I've used the historical returns of the Vanguard Australian Property ETF. As you can see from the results, that initial investment of $24,000 more than doubles in 10 years. And that's without any additional contributions just having the dividend reinvestment plan enabled. With that $50,000 amount now in Vanguard Australian Property, you'd be looking at more than $200 a month in passive income. Obviously, the longer you let this run, the better and better the passive income generation would be over time. And remember guys, this is without contributing any more than that initial investment. If you were to add a little bit of extra money to this, perhaps every year, you could expect even better results. In my opinion, this is a really worthwhile exercise and it's a great option which you can just set and forget. Whilst the returns on a strategy like this may not be as crazy as some of the best growth stocks, it's certainly a fantastic way to harness the power of compounding interest. So is this strategy something you'd consider employing in your own personal portfolio? Let me know in the comments below. I'd like to hear thoughts. Okay, now let's take a look at the company NextDC. NextDC allow customers rapid connection to cloud-based services. They also provide facility for outsourcing data centers for businesses. This business model is very similar to that of Megaport, and they are in fact competitors in the same space. Looking into the annual report of NextDC, we can see a heavy focus on the EBITDA results. NextDC uses this metric as it indicates the company's underlying profitability best suited to its stage of development. Now, this is a curious statement from NextDC. In reality, it's trying to demonstrate to shareholders an improvement in its underlying profit. However, in my opinion, it does not make up for the fact that the business is not profitable. Now, the way EBITDA is calculated is by looking at profit before applying expenses from tax, interest, and depreciation. Now, I agree with this partially. Something like depreciation is an imaginary cost. It's not an expense that the business is actually occurring, and it's a good way for them to reduce their profit in order to pay less tax. The other two exclusions used in the EBITDA calculation are interest on loans and tax. These two expenses will always have to be paid and they are a material expense. So for this reason, I don't think it really warrants discounting them. So looking at the NextDC EBITDA calculation, let's apply what we just talked about. So if we remove the financing and tax costs from the EBITDA calculation and just add back in the imaginary depreciation to the profit margin, an interesting result appears. We can see the underlying profit has actually gone backwards from 2019 to 2020 from 39 million down to 24 million. Nevertheless, this does demonstrate a degree of profitability, albeit heavily adjusted. Whilst this underlying profit may seem optimistic for NextDC, there are drawbacks using the EBITDA method, especially considering it ignores the cost of assets. Investopedia has a great page on EBITDA, which I'll link in the description so you can draw your own conclusions on this calculation. With this in mind, reviewing the annual report, there's no mention from the CEO about a forecast date for profitability. In fact, profitability is not addressed by management at all in the annual report. Perhaps I'm missing something here, and let me know if I am. But in the bulk of the companies that I've reviewed over the past few weeks, management have always set a target date for profitability. I'll give you an example. Let's take a look at Megaport, which we looked at a couple of episodes ago. We can see a definitive focus on profitability from the CEO in their annual report. Whilst the underlying profit or EBITDA of Megaport is not as strong as NextDC, it's clear to see that Megaport's management is more focused on profitability than they are at NextDC. Now, profitability in a business is so important as it generates equity for shareholders. Without being profitable, the only way a company can increase their equity is by borrowing more or by going through more capital raising exercises, which usually means issuing more shares to shareholders. More is revealed about NextDC when we take a deep dive into their financials. We can see a substantial ongoing increase in their total debt figure. I believe this can be attributed to the ongoing development and construction of their data centers, so I'm not too worried about that metric. More importantly, the cash on hand remains more than their total debt. And this is a really positive sign, and it means that if any of the debt becomes due, they can easily pay that debt down. However, as I mentioned just before, This cash is not being generated by business profits. And we can see exactly where this cash is coming from looking at the balance sheet. NextDC continues to issue more and more shares to shareholders in order to raise capital and increase that cash on hand figure. Now, ultimately, issuing more and more shares ends up diluting the stock price. All in all, this is bad for investors because every share you own becomes worth less and less as the company issues more and more shares. What you'd like to see in a healthy company is adding to cash on hand by means of generating a profit and not issuing more shares to shareholders. Now, taking a look at their revenue, yes, it's been fairly consistent and steady. However, it's not increasing at an extraordinary rate. Their net income after tax has also been on a downtrend over the past 5 years. This is also a concerning figure. Now, yes, this downtrend could be associated with the costs of expansion. However, we're not seeing a proportionate increase in revenue. Overall, the balance sheet position of NextDC, in my opinion, is fairly average. Certainly, the growth prospects of their competitor Megaport seem far more appetizing to me. The revenue growth at Megaport is happening at a far greater pace than it is at NextDC. We also know that Megaport has far less debt, and also we know their CEO is targeting profitability because he says it in the annual report. This is something missing from NextDC. For those reasons, even though Megaport is not quite as big and established yet as NextDC, I think Megaport is my pick of the two companies. I'd love to know your thoughts and opinions on these two companies. Perhaps you even own one of them in your portfolio. Maybe you've got some points about either of the two companies that I've missed. Again, drop a comment below. I'd love to have a chat with you down there. Anyway, that's all from me for this week, guys. Make sure to give the video a like and subscribe to the channel if you haven't already. Until next time, take care. I'll see you in the next one. Cheers.